Hello guys, today I'm back with another educational video, and today we'll be talking about how to ride the trend in a bull market from a trading perspective. Now, a bull market, everybody is under the assumption that a bull market is the best time to trade and is the easiest, and there's easy money in the market. Yes, there is easy money, but that is for investors, not for traders. For investors, bull market is the dream market because almost all the sectors are on on a rising trend. Almost all the stocks are going up irrespective of how the fundamentals of the stock are. So for investors it's very good. A bull market is very good because o- over the long over a long period of time, the stocks tend to go up, stocks and the index. But for traders, many traders, even experienced traders, tend to lose a lot of money. So what is the reason for that? When the market goes up in a bull market, the rise is slow and steady. So, for example, if the market is gaining 1,000 points gain will take about 15 to 30 days. In the current, I'm talking about Nifty in its current volatile state on high momentum state. If the market is bullish, so 1,000 point gain in Nifty would take 15 to 20 days. But if there is a correction and Nifty comes down by 1,000 points, this same gain is lost in 2 to 3 days. So the corrections in a bull market are fast and furious, but it goes up slowly and falls down quickly. So this 2 to 3 days phase is where most of the traders lose money. The stop losses are hit, many stop losses are hit, and so on. So how do you avoid this? Or you cannot completely avoid it obviously, but how do you decrease the possibilities of this happening? So for this, let's first understand the market structure basically. So as all of us know, when it market goes up and then corrects a little and then goes up, forms another higher high, and then again corrects and then goes up again. So let me draw this again. So this is how the market moves. Market don't go up in a straight line, and these are called the higher highs and the higher lows. So this point is a higher low, this point is a higher high, this is a higher low, this is a higher high, this is a higher low, and this is a higher high. So this is how the market, and when it moves up it forms supports and resistance along the way, resistances. So this where it last took a resistance is the resistance zone, and this becomes a support zone. And when market breaches this level and breaks, this same resistance zone becomes a support zone for the next higher low. Market comes to the same level around those levels and then bounces up. So this is also called retesting the support, and then it goes up again and breaks this area of this higher high, and this becomes the next support for the market to take when it comes down. So this is how a bull market functions. This all of us know. So, and our ideal entries would be what we have to ride the trend because trend is your friend. So in a bull market you go long. So where do you go long? The ideal areas are these higher lows because that is where you get the most benefit. So this price is less compared to this rise. So this rise is what you want to capture when you want to trade from a swing position, from a positional basis, positional trading basis. So how do you do this? How do you identify when a higher low is formed? So drawing here and showing you guys is really very simple, and you feel like you understood everything. But then when we move to the actual real stocks, then that is where we face our problems. That is where we don't know where to buy, where to sell, and we're confused. So this was basically an example I showed, taking supports and resistances as levels, as main levels in the market. But support and resistance can also be dynamic. For example, a dynamic support resistance is either a EMA, could be an EMA, which is exponential moving average, or an SMA, which is a simple moving average, or anything. It could be a VWAP for a intraday. This it could a VWAP could be a good support or resistance. So support or resistance could be anything. Some people even use pivot points for intraday trading. So support or resistance could be anything really. It's up to a it all comes down to what's working for you, what your trading strategy is. So a dynamic support and resistance would mean if the market is going up in an uptrend, this SMA or EMA would be following the market, and the market would be bouncing off from that line, and it would continue to go up off of this line. So after a while, when the market reaches up, it does, and if it has formed a peak, market doesn't continue falling straight down. That's not how price works, right? So what happens is markets move up and then they consolidate here and move sideways for a while, and then they start moving down. So you can identify a change in trend when their support in the sideways phase is broken. You can say that okay, now the trend has changed and they're in a downward direction. So how do you trade in this market? You can either use trend lines when they're going up, or you can use Fibonacci retracements to uh, identify the levels to enter in, or you could also use candlesticks and you can look for reversal candlestick patterns. Reversal patterns when the stock has moved up and it comes down to its higher low, you could look for reversal candlestick patterns like a bullish hammer or anything of that sort to go long again. And also you could trade based on EMA and SMA as if on a simple moving average or an exponential moving average, like I told you. So those are called dynamic supports. So these are the four basic ways, and at the lowest level, this is the theory part of it. And we can observe these same phenomenon in certain stocks and the index as well, which I would be showing in the next part.